Welcome to this webcast on the new insurance contract standard IFRS 17. Today we will be providing an overview of the IFRS 17 transition requirements. This webcast is part of the series of materials that the International Accounting Standards Board is producing to support the implementation of the new standard. My name is Joanna Yeo, and I'm a Senior Technical Manager on the Insurance Contracts Project.
My name's Conor Geraghty, and I was a Practice Fellow on the Insurance Project.
Before we start, as usual, the views expressed in this presentation are our own, and not necessarily those of the International Accounting Standards Board or the IFRS Foundation. A copy of the slides used in this presentation is available for download through the website. Those slides are accompanied by additional material that we hope you will find useful. This slide outlines the topics in today's webcast. We will begin by providing a high-level overview of the requirements for applying IFRS 17 for the first time. We will then consider the requirements of a fully retrospective approach and the transitional reliefs from a fully retrospective approach that are available when a full retrospective approach is impracticable. We will also cover the other transition requirements, such as disclosures. We have previously published webcasts on IFRS 17, which are also available on our website. This slide shows how this webcast fits in with the other webcasts. The webcast on transition will be on two parts. Part 1 will provide an overview of the transition requirements, and Part 2 will provide further details. You are listening to Part 1.
An entity that reports using IFRS standards and that issues contracts or holds reinsurance contracts within the scope of IFRS 17 is required to apply IFRS 17 in its annual reporting periods commencing on or after the 1st of January 2021. It will also need to restate one comparative period applying IFRS 17. We will discuss this in future slides. Early application of IFRS 17 is permitted for entities that apply the new IFRS standards IFRS 9, Financial Instruments, and IFRS 15, Revenue from Contracts with Customers. In this webcast, we focus on how an entity transitions from their existing requirements and applies IFRS 17 for the first time. To understand what an entity will need to do to apply IFRS 17 for the first time, there are two important dates on which transition requirements are applicable. Let's assume that the entity will first apply IFRS 17 in its annual financial statements in 2021. That is, financial statements for annual periods beginning in 2021. Consequently, the date of initial application is defined as the beginning of the 2021 annual reporting period. The date of transition is the beginning of the earliest comparative period applying IFRS 17. That is, the comparative period is restated applying IFRS 17. When the entity first publishes its financial statements applying IFRS 17, IFRS 17 requires the restatement of only one comparative period. In this example, the entity presents only one comparative period in its annual financial statements. Accordingly, the transition date is the beginning of the annual accounting period immediately preceding the date of initial application. This is what is illustrated in this slide. These dates are important, as the transition requirements are applicable on these specified dates. Let's move on to what will occur on the transition date. We will discuss comparatives in further detail later in the presentation. So, what does an entity need to do at the transition date? IFRS 17 is an IFRS standard that needs to be applied retrospectively unless this is impracticable, something we'll come to a bit later. Applying an accounting standard retrospectively means recognizing, measuring, and presenting the contracts in force at transition date by applying the new standard from the issuance date of those contracts. Applying IFRS 17 retrospectively is shown in the green box, section 1 on the slide. Secondly, all balances currently measured applying IFRS 4 will need to be derecognised. That's shown on the slide in the red box, section 2. This will include the derecognition of all insurance-related balances under IFRS 4, including deferred acquisition costs, cash receivables and payables. There may also be derecognition of some of the investment contract liabilities. This is because some investment components that have been unbundled, applying IFRS 4, do not meet the IFRS 17 separation requirements. Any resulting differences between the IFRS 17 measurement and the IFRS 4 measurement of the contracts will be recognised in equity at the transition date.
The transition method applied is determined for each group of insurance contracts recognized or enforced at the date of transition. The first assessment that an entity will need to perform is whether it can apply IFRS 17 to a group. We will refer to this as the fully retrospective approach. The fully retrospective approach to transition is required by IFRS 17 unless it's impracticable, something that we will cover later on in this presentation. The next few slides provide a high-level overview of applying IFRS 17 generally, and therefore applying the fully retrospective approach to contracts issued or purchased before the transition date. To apply IFRS 17 retrospectively in full, an entity measures each group of insurance contracts in force at the transition date as if IFRS 17 had always applied. That means there is no difference in accounting between, firstly, a group of contracts issued prior to the transition date to which the entity has applied the requirements of IFRS 17 retrospectively in full, and secondly, to a group of contracts issued after the date of transition. This is consistent with the principles in IAS 8, accounting policies, changes in accounting estimates and errors, on how to apply a change in accounting policy. A change in accounting policy is applied retrospectively unless doing so would be impracticable.
To apply IFRS 17 fully retrospectively, an entity measures each group of insurance contracts in force at the transition date as if IFRS 17 had always applied. This will require the entity to have both current information, that is information at the date of transition, and also past information. As a reminder, groups of insurance contracts are measured as the sum of the fulfillment cash flows and the contractual service margin, or CSM. The fulfillment cash flows consist of the present value of the expected future cash flows and the risk adjustment. To apply the IFRS 17 requirements retrospectively, the entity will need to measure the fulfillment cash flows using current information at the transition date. No past information is needed because the fulfillment cash flows are measured at a current value. Besides the fulfillment cash flows, the other component of the insurance contracts is the contractual service margin. The entity will need both past and current information to determine the contractual service margin at the date of transition. We will illustrate this further in a future slide. In addition, entities applying IFRS 17 will need to make a few specified assessments at the inception of the contract or the initial recognition of the group. These assessments are not reassessed after those dates. Also, an entity may select the accounting policy choice to disaggregate insurance finance income or expenses between profit or loss and other comprehensive income. If it does, it will need past information to apply this accounting policy retrospectively. We will use the term OCI option for the rest of this webcast. You may find two of our previous webcasts particularly useful on what we have discussed on this slide. These are firstly, Measurement Essentials of IFRS 17, which provides an overview of the measurement requirements, and secondly, Recognition and Derecognition, which discusses assessments that are made at the inception of the contract. As mentioned before, there are a few assessments that will need to be made as at the date of the inception of a contract or initial recognition of a group of contracts. Further details of these assessments are discussed in the webcast available on our website, Recognition and De-recognition. Some of these assessments require past information. These are determining groups of contracts, assessing whether a contract has a direct participation feature, and for contracts without direct participation features, identifying discretionary cash flows. Applying the requirements of IFRS 17 will mean making these assessments as if the entity were making them at the inception date or date of initial recognition, using the information available at those dates without the use of hindsight. Once those assessments are made, they are not revisited subsequently. As a reminder, for contracts acquired in a business combination or a portfolio transfer, the issuance date and the date of initial recognition is the date of the transaction. Please refer to the earlier webinar on recognition and de-recognition of insurance contracts. This slide illustrates the steps required to determine the contractual service margin for a group of insurance contracts applying IFRS 17 for each reporting date, and therefore also determining the contractual service margin at the transition date. In this slide, and throughout this presentation, we are discussing the approach under the general model unless we specifically state otherwise. There are modifications to the determination of the CSM for contracts with direct participation features, applying the variable fee approach. To determine the contractual service margin at the end of the first reporting period for insurance contracts, the entity begins with the opening balance, determined at the date of initial recognition. Then, interest is accreted on the opening balance of the contractual service margin using the discount rate at inception. The contractual service margin is adjusted by changes relating to future service, and the balance of the contractual service margin is then allocated to recognise the insurance service provided in the period in profit or loss. This allocation is based on coverage units, which reflects the quantity of benefits provided and the expected coverage duration. If a group of insurance contracts is onerous, it will not have a contractual service margin. Instead, that onerous group will have a loss component and an onerous loss which is recognised in profit or loss immediately. As with the contractual service margin, the determination of the loss component at transition date will require both past and current information. In addition, the contractual service margin and the loss component are key factors for the determination of insurance revenue. Further details on the determination of the contractual service margin and the loss component is provided in the Measurement Essentials of IFRS 17 webcast, available on our website.
As mentioned earlier, an entity has an accounting policy choice to disaggregate insurance finance income or expenses between profit and loss and other comprehensive income. An entity needs both current and past information to determine this disaggregation. For example, both past and current information is required to determine the amount of insurance finance income or expenses reported in profit and loss. In addition, sometimes the cumulative amount of insurance finance income or expenses recognized in other comprehensive income is required to determine that amount presented in profit and loss. Determining that cumulative amount will require both current and past information. To apply IFRS 17 retrospectively in full to contracts in force at the date of transition, the entity must apply the requirements of IFRS 17, which needs both current and past information. The availability and quality of past information will determine if an entity can apply the requirements of IFRS 17 retrospectively consistent with IAS 8. Retrospective application may be impracticable because contracts issued many years ago may not have the relevant information, or because such information requires the use of hindsight. Examples of where retrospective application might be impracticable is the determination of the contractual service margin at initial recognition, because it would, amongst other things, require the discount rates, estimates of cash flows, and the risk adjustment for non-financial risk at the date of initial recognition. When the entity is prohibited from applying IFRS 17 fully retrospectively because it is impracticable, IFRS 17 provides transitional release in the areas where past information is required. The next slide provides an overview of the transitional release in the areas where past information is needed to apply IFRS 17.
One of the options available to entities if a full retrospective approach is impracticable is to apply a modified retrospective approach. However, an entity can only apply this modified approach if it has specified reasonable and supportable information. We discuss this further in the next slides. We will now provide an overview of the modified retrospective approach specified in IFRS 17. The objective of the modified retrospective approach is to achieve the closest outcome to a retrospective application possible using reasonable and supportable information available without undue cost or effort. Accordingly, an entity should maximize the use of information available without undue cost or effort that would have been used to apply a fully retrospective approach. To the extent there is no reasonable and supportable information for a fully retrospective approach, an entity must use specified modifications. This slide provides an overview of the assessment areas in which modifications are permitted, but only to the extent the entity does not have reasonable and supportable information for a fully retrospective approach. The modifications specified in IFRS 17 are available for the information necessary for an entity to make the assessments applicable at inception or initial recognition, the determination of the contractual service margin or loss component of the liability for remaining coverage at the transition date, and therefore insurance revenue going forward. There are specific modifications for contracts with direct participation features, and determining the basis for the disaggregation of the insurance finance income or expenses between profit or loss and other comprehensive income. This is only applicable when an entity has elected to disaggregate insurance finance income or expenses between profit or loss and other comprehensive income. Each of the modifications can only be used when the entity does not have reasonable and supportable information it would use for full retrospective application, but does have reasonable and supportable information to apply the specified modifications. For example, if an entity has reasonable and supportable information about the initial assessments it would use applying a full retrospective approach, it should use that information. If it does not have such information about the determining the contractual service margin, but does have reasonable and supportable information necessary to apply the specified modifications, it must use the modifications. Detail of the modifications permitted applying the modified retrospective approach are covered in an accompanying webcast, Transition to IFRS 17, Part 2.
If a full retrospective approach is impracticable, an entity could choose to apply a fair value approach instead of a modified retrospective approach. However, an entity must use the fair value approach if it does not have reasonable and supportable information to apply the modified retrospective approach. We will now provide an overview of the fair value approach specified in IFRS 17. When we talk about the fair value, there is a difference between the cash flows that occur when an entity is sold and when a liability is transferred. When an asset is sold, the buyer pays the price to the seller to buy the asset. For a liability, it is the other way around. The transferor of the liability will transfer both the liability and the price of doing so to the acquirer. That price is the fair value. The next slides explain what is meant by fair value and how the fair value approach is used at transition.
The fair value of a group of insurance contracts is measured applying the principles of IFRS 13, fair value measurement, with one exception. IFRS 17 requires that in determining the fair value, the entity should not apply the concept of a deposit floor. Applying IFRS 13, the fair value of a group of insurance contracts would be equal to the price paid by the transferor to the acquirer for the transfer of insurance liabilities. Applying the IFRS 13 definition of fair value is an exit price. It is a price set in an orderly transaction and not a price set in a liquidation sale or forced sale. The transaction is between market participants, so it is a market-based view. Fair value is a current price and is set at the measurement date, which is the date of transition to IFRS 17. In the case of the transfer of insurance contract liabilities, the fair value of the insurance contract liabilities at transition would be the price insurer A would pay if it was transferring the insurance liabilities in the normal course of business to insurer B at the transition date. Insurer B, the transferee, is a normal market participant.
The fair value approach is used to determine the contractor service margin or loss component on the date of transition. If the fair value of a group of contracts is larger than the fulfillment cash flows, the insurance liability is measured at the larger amount, the fair value amount. The contractor service margin is the difference between the fair value and the fulfillment cash flows of the group. If instead the fulfillment cash flows is larger than the fair value of a group of contracts, the insurance liability is measured at the larger amount, the fulfillment cash flows amount. The loss component is the difference between the fulfillment cash flows and the fair value of the group. Details of further reliefs permitted applying the fair value approach are covered in an accompanying webcast, Transition to IFRS 17 Part 2.
The transition approach adopted is determined on a group of insurance contracts basis. This means that different generations of the same insurance product might be measured applying different transition approaches. This is demonstrated by the example on this slide. This example shows different generations of the same insurance product issued over 3 periods in time. All of the groups of insurance contracts are still in force at the transition date. In this scenario, information is available to apply fully retrospective application consistent with IS 8 to groups of contracts issued from 20YY. Accordingly, the entity must apply the requirements of IFRS 17 retrospectively in full. For long-term coverage contracts, in practice, there will be a limited number of contracts applying IFRS 17 fully retrospectively due to the lack of quality information to do this. For contracts issued before 20YY, it is impracticable to apply the full retrospective approach. However, for contracts issued between 20XX and 20YY, the entity has reasonable and supportable information available to apply the modified retrospective approach. In this case, the entity has a choice to apply either the modified retrospective or the fair value approach. Before 20XX, there is no reasonable and supportable information to apply the modified retrospective approach. Consequently, the entity must apply the fair value approach for contracts issued before 20XX. We have been discussing applying IFRS 17 for the first time. A group of insurance contracts is measured as the sum of the fulfillment cash flows and the unearned profit or contractual service margin. The fulfillment cash flows are the present value of future cash flows and the risk adjustment. In summary, a group of contracts issued prior to the transition date to which the entity has applied the IFRS 17 fully retrospectively is measured consistently with a group of contracts issued after the transition date, that is, for new business after the date of transition. Because retrospective application of IFRS 17 is impracticable, the affected group of contracts will need to apply the transition reliefs which relate to determination of the contractual service margin or the loss component. The fulfillment cash flows for a group of contracts issued prior to transition are measured consistently with the new business issued after the date of transition, no matter which transition approach is used. This is because the fulfillment cash flows are measured using current information.
The last section of slides provides an overview of other matters relevant to applying IFRS 17 for the first time. As mentioned before, in the entity's first financial statements applying IFRS 17, the entity must restate the comparative information for the prior period immediately before applying IFRS 17. An entity may choose to present comparative information for more than one prior period. The entity can choose to either restate those earlier periods applying IFRS 17 or present that period unadjusted. Let's look at an example. The entity first applies IFRS 17 in its 1st January to 31st of December 2021 financial statements. In the 2021 financial statements, the entity must restate the comparative period immediately before, which is its 1st of January to 31st of December 2020 annual period, applying IFRS 17. While IFRS standards requires a minimum of one comparative period to be presented in the financial statements, the entity may present additional comparative periods. Accordingly, when presenting the 2021 financial statements for the additional comparative period, the 1st of January to the 31st of December 2019, the entity could either restate the 2019 period applying IFRS 17 or present the 2019 period unadjusted, that is, using amounts presented in prior financial statements. If an entity chooses to present unadjusted amounts, it must disclose this fact and explain the basis. The date of transition is the beginning of the first comparative period in which the entity first applies IFRS 17. If the entity chooses to restate the 2019 period applying IFRS 17, in this example, the date of transition is the 1st of January of 2019. If the entity chooses to present the 2019 period unadjusted, that is, not apply IFRS 17 for 2019, the date of transition is the 1st of January of 2020.
On the date of initial application of IFRS 9, entities must assess and classify their financial assets. This includes an option to designate financial assets as measured at fair value through profit or loss. When doing so, mitigates an accounting mismatch. This is known as the fair value option. Some insurers will initially apply IFRS 9 and IFRS 17 at the same time because they qualify to defer the implementation of IFRS 9 and choose to do so. Some entities will apply IFRS 9 before they apply IFRS 17. For entities that apply IFRS 9 before they apply IFRS 17, IFRS 17 permits, but does not require, the reassessment of some classifications, elections and designations related to particular financial assets. Additionally, these entities must revoke the fair value option if a financial asset no longer meets the IFRS 9 specified conditions because of the application of IFRS 17. That means where previously there was an accounting mismatch and therefore the fair value option was applied, but now there is not. There are disclosures applicable when entities apply these requirements in IFRS 17 relating to these financial assets. There will be some differences in the measurement of the contractual service margin and consequently revenue when applying the different transition approaches in IFRS 17. IFRS 17 requires disclosures to identify the effect of groups of insurance contracts measured applying the modified retrospective approach or the fair value approach on the contractual service margin, and revenue in both the period it first applies IFRS 17 and subsequent periods. IFRS 17 requires that the entity should explain how they determine the measurement of insurance contracts that existed at the transition date for all periods in which these disclosures are required. These disclosures will allow users of financial statements to understand the nature and significance of the methods used and the judgments applied. Also, an entity will have to disclose separately the reconciliation of the contractual service margin for groups of contracts to which the entity has applied the modified approach and the fair value approach. This will be required for all reporting periods until these contracts are derecognised. Also, some entities on transition will choose to disaggregate insurance finance income or expenses between profit and loss and other comprehensive income, something that we refer to as the OCI option, and apply the transition release. In this case, there are additional disclosures for the related financial assets.
That is the end of today's webcast, Part 1, an overview of the transition to IFRS 17. For more details of transition release when applying the modified retrospective and fair value approach, please watch the accompanying webcast, Part 2, which will also be available on our website. We hope that you found Part 1 useful. As stated before, we intend to produce future webcasts and other materials to support the implementation of IFRS 17. Thank you for listening to today's webcast.
Thank you and goodbye.